Welcome to you. Thank you very much for making the time to join this Employment Taxes webinar. Good afternoon, everyone. So just by way of introductions, my name is Minesh Trivedi. I'm a partner and head of employment taxes at Claritas Tax. And I've got my colleague, Nikhil Trivedi, who's an associate, who will also be helping me present some parts of the agenda. Talking about the agenda, so today it is going back to basics a little bit. And look, I make absolutely no apologies for going that way, because the areas I'm going to cover today keep on the quite common issues, both in terms of when we carry out due diligence work, but also from an HMRC perspective, these tend to be recurring irregularities that keep on cropping up time and time again. So in terms of the agenda, I'll be covering, sorry, Sally, just go to the next one, please. Thank you. So in terms of the agenda, something that's very, very topical around employment and IR35 status. Again, like I say, these seem to be coming up time and time again during tax DD work. Secondly, around employee benefits. So we are approaching the P11D and PSA season very shortly. Something to perhaps bear in mind. Company cars and company vans, again, no apologies for mentioning this again. This is one of the main common pitfalls during HMRC employer compliance reviews. So again, I just want to cover that off in terms of how they're taxed. Next one will be the employee travel expenses. Now, for most employees, this will be pretty straightforward because they'll have a permanent workplace, and therefore it's quite well known that any mileage reimbursed for home to work mileage would not be considered business and therefore would not attract any tax relief. So again, I just want to cover off that, mainly because we've now gone into post-COVID, gone into more and more hybrid working. So I just want to cover off some of the complex rules around that. And then I'll go on to some general update in terms of HMRC compliance activity, and perhaps one or two other things I just wanted to mention to help you. And lastly, we'll have some time for some Q&As that you may have. So just going on to the next one, then please, Sadia. So like I say, employment status and IR35 status does continue to be quite a hot topic with HMRC. Always has been, always will be. And like I say, this is in 80% of the DD projects that we get involved with will have some form of IR35 or employment status issue crop up. Would that be directors or non-executive directors, consultants, subcontractors, and such like. Now, I think the main reason it tends to be, tends to crop up as an issue is because there is no legislation around employment status or IR35 status. It has been talked about by HMRC for quite some time, but it hasn't quite materialized. And I think if there were to introduce some sort of legislation, it will take some of the grey areas out of the equation. So anyway, in the absence of any legislation around employment and IR35 status, we have to rely on some decisions that have been made in past case law. Now, traditionally, HMRC have relied on or have considered a number of factors. And effectively, there are 4 main factors that HMRC will look at. So the first one is control. So who controls the work that the worker undertakes, albeit directly as an individual or via some sort of an intermediary, commonly personal service companies. So control is the key one that HMRC will look at. And what that really means is, okay, who tells its worker what to do, how to do that work, when to do it, and where to undertake that piece of work. If the answer to all those questions is the engager who dictates the control on how the work is being done, then that will be more indicated towards employment status or within IR35 status if they're operating through an intermediary. The second one is right of substitution. So if the requirement is that the work has to be carried out by that worker personally, then chances are that that will be an indicator more towards within IR35 or unemployment status. So right of substitution is quite an important one. Thirdly, financial risk. So what do HMRC actually look at when they talk about financial risk? So the questions I'll be asked would be equipment. So what equipment is required for the job and who actually provides that equipment? Now, commonly for an office-based person, you'll probably need your laptop or your mobile phone, but actually in reality, HMRC tend to ignore those type of equipment, if you like. They're more concerned about the more heavy equipment that, and it's more towards, I guess, on the equipment, it's more towards the construction sector, effectively, in terms of who provides all the diggers and all that sort of stuff. However, the second one they'll look at is materials. Who provides all the consumables, any materials required for that piece of work? If the answer is it's the contractor or the consultant, then chances are that will be more of an indicator towards self-employment or outside of IR35. But actually, within financial risk, what HMRC have been known to know, and I have had a number of cases with HMRC where it's really fallen down on the next one, which is the insurance. So who actually provides the insurance cover, be it professional indemnity insurance or employer liability insurance, etc. If the answer is it's the worker who provides that insurance at their own cost, then that is likely to point more towards self-employment or outside of IR35. And the third, and I suppose the next one that HMRC will look at under financial risk is the basis of pay. So are they getting paid a daily rate? Is it per hour? Is it per project? Is it per session, etc.? If the answer is more around they get paid by the hour, then HMRC will conclude that actually that's no different to an employee benefit, and therefore it's likely to point more towards employment or within IR35 status. So I've talked about control, I've talked about right of substitution, I've covered financial risk. The fourth one is quite an interesting one because HMRC don't really put a great deal of attention to this, and that is a mutuality of obligation. And in simple terms, all that means is the engager obliged to provide the worker with work, and equally is the worker obliged to accept that piece of work for a fee. Now, if the answer is yes, then that's likely to point more towards employment status. And I'll talk about some examples in tribunal a bit later. So, like I say, HMRC don't put a great deal of importance on the mutuality of obligation, but funny enough, the tribunals do. Again, I'll cover that off later on. And if those factors that I've mentioned so far aren't conclusive, HMRC will also look at other factors. One being the part and parcel test. So effectively, all that means how much part of the organization, how much integrated are you within that business? So the sort of things HMRC will look at there is, look, if you've got a company email address, then they might look at that as an indicator towards employment status. If they're invited to company Christmas parties or gatherings, again, they could look at that as an indicator towards employment status. But more importantly, around the part and parcel test, if they report to somebody up the chain or they have some reports lower down the chain, then chances are they will be regarded more integrated within a business, and therefore that would point more towards employment status. The next one is exclusivity. So if there are any restrictions in the agreement or in the contract which prohibits that worker from working elsewhere, then that again will be an indicator towards employment status. And again, I have seen this in practice, so benefits in kind, so company cars, private fuel, medical, or any statutory payments. If the worker is entitled to any of this, then again, HMRC are likely to view that arrangement more towards employment status or within IR35 status. Now, to give you some examples, I have seen self-employed workers, one in particular, until HMRC came along, they were clearly working exclusively for the engager, or the engaging company. They had a brand new Range Rover, they had a company mobile phone, they had a company laptop, but yet they were still being treated as employed, self-employed rather, until HMRC came along. So I think taking all these factors into account, the key question HMRC want to know is, can this worker be regarded as being in business in their own right? And if they are, they're willing to take the risks as well as profit from that arrangement, then chances are that we can argue that the individual is genuinely self-employed or outside of IR30. The last point on there is quite an important one. So again, I've seen so many contracts in practice that are IR35 proof, or they're a genuine self-employed contract. But actually, when you look at the actual working practices, it's entirely different to what the written agreement says. And look, whilst HMRC will look at the written agreements, they will pay more attention to how the actual working practices are followed. And I've known HMRC to have interviewed workers to see if their side of the story matches up with what the engaging party's version may be. So again, it's absolutely important that any written contracts do reflect the actual working practices. So quick, thank you. So I suppose in terms of some recent developments, so like I mentioned, the mutuality obligation test. So whilst HMRC have an approach on IR35 and employment status, the recent developments in certain tribunal decisions, Athol House, for example, and RALC Consulting, have demonstrated actually the thinking around this whole area from a tribunal perspective is a little bit different to HMRC's. So in some of the more recent cases, the focus from a tribunal and how they've actually arrived at the decision has been a little bit different to HMRC's. So, and to be honest, and just to support that, if we look at some of the more recent cases, HMRC have lost more cases than they've won. And I think that's down to some of the pitfalls with their CESTOL, for example, and I'll come on to that in a minute shortly. So the focus from a tribunal perspective, clearly there's that focus on control, which I mentioned earlier. So that's one factor they'll put a lot of weighting on. The second one is whether this worker is in business on their own right, i.e. can they profit or make a loss on their own, depending on how they actually conduct their business. If the answer is yes, then that's likely to point more towards self-employment or outside of IR35. The third one is around the stress test, and this is more related to the last point I made on the last slide, which was the working practices and the written agreement. So the test here from a tribunal perspective is whether the contract as was written was actually intended to be delivered in practice. If the answer is no, then chances are the written contract would simply be thrown away or thrown out of the window. So that's the stress test, and that's what the tribunals seem to be paying a lot of attention to. And like I say, the last one is around the mutuality of obligation. HMRC have their view, don't put too much importance on it, but yet it's quite evident from some cases, more recent cases from a tribunal perspective, that is quite an important obligation. Now, to give you an example of that, there was a case that involved a urologist who had two separate contracts with two NHS trusts. One didn't have any mention about the number of hours that he must undertake his work. The other one did. So the one that didn't basically fell outside of IR35, whereas the one that mentioned that he must provide 15 hours of his time that week, or 10 hours or whatever it was, then that contract fell within IR35. So I think the importance there is, it is quite important how much importance rather the tribunals put to the mutuality of obligation test. The famous HMRC CEST tool, so check employment status for tax. Now, I'll be honest with you, I'm not a big fan of it because it's one size fits all sectors. And as we know, all sectors don't quite operate in exactly the same manner. So those of you who haven't come across it, this is an HMRC online tool, which engagers can use, or even contractors can use, to see how HMRC are likely to view that arrangement. Now, potentially there are three outputs. So based on the answers you provide, it will come up with three main outputs. The first one being, yes, this arrangement falls within IR35, or this engagement is employed for tax purposes. The second one might say it's outside of IR35 and therefore not an issue. And then the third one is one that doesn't help anyone at all. So it will basically say, based on the responses you've provided, we are unable to determine the status of this arrangement. So I'm not quite sure what the engaged are meant to do in that sort of circumstance. Now, I must say, I say use it at your peril, and I do mean that. Because whilst HMRC put a lot of emphasis on it, it's skewed more towards what they want to see by way of an output, in my view. It's also come under a lot of criticism and scrutiny in the tribunals. And I think the more important thing to say is, look, this CES tool, whilst HMRC have put it out there, it has no legal impact on you. Okay. But like I say, if HMRC come along, well, some of the first questions I'll ask you is as to what extent have you used HMRC CES tool to determine status of your workers? And of course, the consequences of getting wrong are quite significant because, and this is one point I will make. So when we talk about IR35, so sorry, when you engage an individual directly, IR35 does not apply. IR35 only applies where you're engaging the workers' services through an intermediary, quite commonly a personal service company. So when we talk about employment taxes, that issue has been there and will continue to be there forever. And it has been, like I say, in the past. So you're looking at all those factors I mentioned earlier in relation to the individual. And the risk sits with the engaging company. So if HMRC come along and say, okay, you've employed Minesh Trivedi or engaged Minesh Trivedi for all this time on a self-employed basis, we think he should be on the payroll. Now, in that circumstance, HMRC can go back 6 years for both tax and national insurance purposes, or even longer if they believe there was some fraud or negligence involved. Comparing that to, so I suppose in terms of consequences going on, if the employees engage somebody directly and HMRC have a different view, then HMRC can go back 6 years for tax and national insurance. Where you've engaged an individual via a intermediary, say typically a personal service company, then clearly we've got the changes in the IR35 rules which came in from April 2021 or 2017 in the public sector. So that's your start line. So any liabilities would only rest with the engaging company if they were a medium or a large company, and HMRC determined that arrangement to fall within IR35. Okay. Now, some recent developments around this. So previously, HMRC, where you engage an individual directly, there was legislative support for HMRC to give that offset of any tax or national insurance paid by the individual through self-assessment. From April this year, there have been some common sense changes, which basically mean that if somebody has provided their services via an intermediary, then whatever tax they've paid, be it income tax on their dividends through self-assessment or corporation tax that they've paid on the profits they've made, HMRC are now obliged to give you an offset or give you credit for the tax and NIC already paid, and that is in legislation. Okay, so at this point, I'll pass you on to Nikhil, who's going to cover off PSAs in a bit more detail.
Hi everyone. So my name's Nikhil Trivedi, and I'm an associate at Claritas Tax, and I'm part of the employment taxes team. So I'll be talking to you about PSAs and P11Ds as the season is nearly upon us. I won't be focusing on P11Ds today, as they are fairly self-explanatory and it's quite clear on the benefits and expenses that need to be included, and I'm sure most of you have seen or come across them before. So the focus will be on PAYE settlement agreements, PSAs. So previously, HMRC used to be quite relaxed about what's included on the PSAs, but recently they've been a lot more stricter of what can be included on it, and these are minor, irregular, and difficult to apportion items. And difficult to apportion can mean, for example, you've got Christmas parties, and it's quite difficult to apportion to each employee what their cost is, as some may have more drinks than others, some may come later, earlier, so it can be quite difficult to determine the exact cost per employee, and it can be quite impractical to work out. So in most cases, it's easier to put on a PSA. Typical examples of items included on a PSA are staff entertaining, staff gifts, and welfare, this including non-cash vouchers. And one thing to be mindful of, there are exceptions, such as long service awards. So there's a minimum of, if there is a minimum of 20 years that an employee has been at a company, then that's exempt. Trivial benefits, which is a £50 limit. Suggestion schemes, the awards or rewards can be given to employees from these, which up to a certain limit are exempt from tax or NRC. Another exemption is annual functions. You have the £150 limit if it's available to all employees and is annual. So these are exemptions to be mindful of that you don't need to include it on a PSA if these conditions are satisfied. With PSAs, they will have to be agreed with HMRC, be put in place by the deadline, which is 6th of July. So for this year, 6th of July 2024. So there is still time to agree a PSA with HMRC. But one thing that we recommend is to have it put in place sooner rather than later. And anyone who's dealt with HMRC can all agree that there's a big possibility of timely delays. So get it sorted sooner rather than later. And moving on, once agreed, it stays in place until cancelled. So you don't need to sign up every single year or apply for it. Once in place, then it's in place until cancelled or varied. And if you are, for example, you have staff entertaining and then you suddenly start providing staff gifts, that's the varied aspect, which you then can add on and then start declaring staff gifts that are provided. And the calculations of the tax / Class B1 NIC need to be submitted by the end of July, followed by payment of the tax / NIC on the 22nd of October. But this is if paid electronically. If paid by cheque, then this must be submitted by the 19th of October. So obviously if it's electronically, you have an extra 3 days to submit the payment. So with PSAs, it's a convenient way to settle the tax on employees' behalf, but it does come with extra costs. Extra costs. And this is because the tax is payable on a grossed up basis at the employee's marginal tax rate. So because of this, so the Class 1 NIC is payable at 13.8% on the benefit in kind value and the grossed up tax. So this does create an extra cost. And just to put this into perspective, so an employee who has a marginal tax rate of 20%. So for every £1 of benefit in kind that is kind of given to an employee, it's a cost of 42 pence. So that total cost will be £1.42 to the company. And for a taxpayer at 40%, this is an 89 pence per pound. So totaling a £1.89 cost to the company. So while it can be useful and helpful, this is one of the additional costs that comes with PSA. That's me done. I will now pass you back to Minesh to carry on. We'll talk about company cars and vans and private use.
Thanks, Nikhil. So yeah, moving on to company cars and vans, and I'm pretty sure a lot of us will be familiar with these type of benefits. But I wanted to make more of a put more of a focus on private fuel and how, in my experience, both when I was with HMRC and also this side of the fence, how often this becomes an issue. So just as a reminder, for company cars, yes, usually it's a reportable benefit uh, where that vehicle is made available for private use. Sorry, Talia, the next slide, should have said that earlier. Apologies. Yeah, so company cars are usually a reportable benefit where it is made available for private use. And that availability is the key point in this. Because if you remember, during COVID, when people just wanted out to travel, they had their company car sat on the drive, they were still liable to tax because in theory, it was still available for employees' private use. Uh, Comparing that to just jumping down on company vans, the way company vans are taxed is the actual personal usage rather than availability. And that, like I said, there are some exceptions there to private use. So people working on a particular site, and a construction site, taking that van from their home to site and back again, or having some unincidental or insignificant private use, like taking the dirty mattress or old mattress back to the tip, or dropping their kids off to school en route. Those type of journeys would not be classed as private. Well, they are private, but they are ignored for this purpose. So just going back to the main issue around this is a private fuel. So again, in my experience, the record keeping is absolutely paramount here. And again, I've known HMRC to have claimed quite a significant liability from clients where they haven't kept accurate records of business or private mileage. And they have come out with this, okay, you reported the company car on the P11D, but actually we believe there is some private fuel benefit involved here. So it is quite a common pitfall. Again, I'll cover this off later on. And then pool cars. Again, number of cases I've come across where clients have just said, yeah, that's a pool car, but actually when you dig a bit deeper, one, they haven't got any records to prove that it's a pool car, doesn't satisfy all the conditions that you need to satisfy on pool cars, and therefore HMRC seek a recovery. So literally in the last 10 days, there has been a first-tier tribunal case. So this is a company that deals in commodities. They have some very, very wealthy individuals in Yemen and Qatar. So they invested in or leased 12 quite prestige cars, including Porsches and Teslas and BMWs, etc. Now, that case went, like I said, to first-tier tribunal, and HMRC were contending that actually there is some private use, and therefore we want the Class 1A national insurance paid. Now, just to give you some idea of what actually went on, so the criteria around a pool car is essentially that the pool car has to be provided for the employee for use by virtue of their employment. Secondly, it shouldn't be used by anyone at the exclusion of everyone. So effectively, you can't just allocate a car to an individual for their use, or for a handful of individuals at the expense of others, and say it's a pool car. HMRC won't wear that. Thirdly, you've got to make sure that it's not kept at or near the employee's home overnight. And fourthly, and quite importantly, you've got to make sure that it's not available for private use, whether it's through your company car policy, whether it's through a regular memo to those employees, is what HMRC will be looking for. So coming back to the case, the first-tier tribunal case. So effectively, in that case, they had basically the main director and the wife and the son who were all involved in the business, and the actual address was the registered address was exactly the same as the company registered address was their residential address as well. So HMRC looked at it, and actually, when they started asking questions, it uncovered actually there weren't any records kept at all. And in fact, the son and the wife were using those prestige cars for private use. So HMRC basically won the case. I think it's about 51,000 that they have to pay over, unless obviously they appeal against that decision. Okay, so that's company cars and company vans. Yeah, I think record keeping is probably quite key to avoiding any issues with HMRC. Okay, can go on to the next one, please. And again, this is a more quite a related issue here, because without knowing, you could fall into the trap of that private fuel issue I've just been talking about. So again, employee travel expenses, and again, I appreciate this is quite a well-trodden path, and you'll have some policies in place to tell employees what is and isn't business or private mileage, and therefore providing clarity as to what they can actually claim on their expense claims. So the business mileage often, it will be dictated by the employee's normal place of work. The more straightforward one is where people have a permanent office or a depot where they're based. And it's quite well trodden again in terms of any home to work mileage would be ordinary commute, and therefore they can't claim that. Certainly you can't claim that tax or NMC free. And then some of the complications around geographically based. So these are people who have a designated area as their normal place of work that they cover. Now, where I've seen employers fall foul of this is where the employee lives outside of that area. So effectively, the rules say that if the employee lives outside of that geographical area that they're responsible for, then the journey from their home until the tip of that or the border of the area will be counted as ordinary commute, and therefore they should not claim that free of tax or national insurance. All other journeys within that geographical area will be permitted, and therefore, because they're traveling the performance of their duties. So all that would be allowable. The third one there is where HMRC have been talking about perhaps just changing the rules a little bit here, but they haven't. So the rules are exactly as they were before COVID, as they are now. Now, the complication around home-based and hybrid working really depends on how that arrangement works in practice. So if the arrangement is quite voluntary, then chances are that the employee can't claim any mileage if they were to be called into the office. All that will still be ordinary commute, and therefore taxable and nickable. However, if there is a formal home working arrangement with the employee, i.e. it's in writing, it's all contractual, etc. And for example, it might say that Monday, Tuesday, Wednesday, the employee works from home. Thursday and Friday, they are required to be in the office, which is not unusual nowadays. So in the example of Monday, Tuesday, Wednesday, if they are called into the office on one of those days, then they can, in theory, claim that journey, because they're supposed to be working from home Monday, Tuesday, Wednesday. But if they're called in to attend a meeting in the office, then they're going to a place where it's not their permanent workplace. Whereas obviously on Thursday and Friday, when they go into the office as for the contract, they can't claim that journey because it's normal, ordinary commute, and therefore they can't claim that tax and NMC free. So ordinary commute, I've already covered that off. Permanent workplace. So this is broadly, and it is broadly, this is where a worker spends more than 40% of their time undertaking their duties of employment. However, if they have got a regular pattern to their journeys into a workplace, then that in itself could trigger and make that place a permanent workplace. So for example, if a particular worker went into the office every Thursday each week, then that potentially could create a permanent workplace. However, depends on what they're going there for. If they're going there for a temporary workplace, as in they're going there for a limited duration or for a temporary purpose, then chances are that HMRC will view that workplace as temporary, and therefore that shouldn't give them an issue. So they can still claim the mileage to the temporary workplace as business mileage. So when we talk about limited duration, typically we're looking at meetings or site inspections. So long as they just go there, finish off that piece of work, and then head back home or head back to the permanent workplace, then we wouldn't have an issue. So why is this all important? Well, it's important because if your employees are traveling what they thought was business and then turns out to be personal mileage, then clearly whatever their claim will be subject or should be subject to POIE and NIC via the payroll. But where the potential problem really kicks in is where that employee has a company car. Now, depending on your policies around private mileage, you could trigger the private fuel scale charge, which at the moment and it keeps on going up every year. So I think for this current tax year, it's about 27,800, and that multiplied by the car's CO2 emission percentage to give you that benefit in kind. And of course, the company has to pay the class 1A on that benefit as well. So it can become very, very expensive if you're not careful. Okay, moving on to just the general update, please, Tanya. Thank you. So just to give you a bit of an update, so if we look at pre-COVID, there was a lot of talk about HMRC increasing their activity around employer compliance, etc., quite a bit. And then, of course, we had COVID. We had furlough claims made left, right, and centre for a period of 18, 24 months. Now, obviously, after that, HMRC were just handing out money, and they found that actually there was about £7 billion worth of CGRS claims, the furlough claims that had been made fraudulently or incorrectly. So all their resource around employer compliance were moved to looking at these claims in a bit more detail. That seems to have quietened down, and therefore what we have seen, or I'm certainly seeing, is a marked increase in that activity from HMRC. So would that be employer compliance, i.e., in other words, a full-blown POI and NIC audit, or it might be a focused one. So I've just had a letter literally last Thursday from a client that they got from HMRC. It's a construction business. They just want to look at their subcontractors and how they've been treated from an employment status perspective. Again, construction industry scheme. Again, I've experienced, I've seen a lot of increase around that, and I'll have speaking to my colleagues or ex-colleagues I used to work with. They're having exactly the same experience. National minimum wage and living wage, that I would say has been HMRC has been quite active for the last 18 months, if not longer. And all they look at is national minimum wage and living wage and nothing else. There are those specialists within HMRC. And lastly, like I mentioned earlier, just specific reviews around employment status and IR35 status. Personally, I can see an increase in that area in the next 18 months or so. So given we had the rule change in April 2021, where the IR35 rules changed in the private sector, I think HMRC just want to wait a bit longer. So if there are any issues, they've probably got about 3-4 years worth of liabilities that they can recover, as opposed to going in after 1 or 2 years. So that's more our HMRC activity. On the company cars, so again, this is following the upper tier tribunal case. I'm sure you would have come across the Langerock and Wilmot Dixon cases. So these cases involved employees that were paid a cash allowance. I didn't have a choice between a company car and a cash allowance. It was pure cash allowance. And on top of that, for every business mileage they travelled, they were paid a rate which was below HMRC's approved rate, which is 45p up to the first 10,000 business miles, and then 25p thereafter. So because they met those criteria, I mean, this has been a long-running saga for quite some time until HMRC lost on these 2 cases, which basically said that, okay, if the individual's getting paid less than the HMRC rate, the 45p and the 25p, then they can claim tax relief on the difference via the self-assessment. So they're getting relief. There is that facility available. But there was nothing around national insurance. So what this case said, look, if you look at your business mileage per pay period, And if we look at the difference between that, what you actually got paid and the HMRC rate, you should be able to claim the national insurance relief from that as well, both employees and employers. So there's two aspects to this, I guess. One is the retrospective position. Now, clearly, you need to have a decent number of employees who received cash allowances, because the amount of work involved and trying to present that to HMRC can be quite significant. So there is a retrospective position, but there's also the go forward position. So HMRC have backed down, and I'm going to take this to appeal as far as we're aware. So you may want to just improve or amend your processes going forward. So you're getting that advantage of the national insurance relief on any business mileage going forward. So if that's something you want to consider, then more than happy to have a chat. And the last thing I wanted to raise was the advisory fuel rates. For those of you who may not know, HMRC do update these rates every quarter, and they have been changed from 1st of June later on this week or early next week. And the net effect is, look, the petrol price has obviously been going up, as have the diesel over the last few months. So those have increased in line with the petrol pump prices. However, the electric rate has been reduced from 1st of June onwards from 9p to 8p a mile. So these rates, just to be absolutely clear, can only be used in two circumstances. One, where you're reimbursing an employee for their business mileage and they have a company car. Secondly, where you don't want the individual to suffer, so if they've got a company credit card or fuel card rather, and you require them to reimburse the private miles back, you can reuse those rates again as a basis for them to reimburse the private mileage without incurring a benefit in kind. So that is me done. Can we go on to the question and answers, please, Sally? Thank you.
Yeah, so we do have one question here. So regarding IR35, can the tax/NIC be offset against any PAYE NIC liabilities?
Yeah, so like I say, for individuals, where you engage individuals directly, then clearly IR35 is not in point. So in that case, HMRC historically and legislatively had to provide an offset for the tax and any class 2 or class 4 national insurance paid by the individual via self-assessment. Whereas from April, like I say, the rules have changed, and there is legislation around this which says that if that company or that personal service company that you've engaged the worker through, if they've paid any or paid themselves a small salary plus a dividend on top and paid income tax, but also paid corporation tax to their personal service company, then HMRC is duty bound to provide that offset of the tax and NIC paid.
Another question we have is, what is the new mileage allowance from the 1st of June 2024?
So yeah, I haven't got the exact rates in front of me, but effectively for the petrol and diesel, they have increased by 1 or 2%. So you're probably aware it goes from 0 to 1400 cc and then 1400 to 2000 cc and above 2000 cc. So I think looking at that, they've probably gone up by a penny or two for all those cubic capacities. But like I say, for the electric vehicles, it has gone down. I suppose reflects the reduction in energy prices, I guess.
We have two more questions. Is compliance with the apprenticeship levy still a key focus area for HMRC?
That's a very good question. And I say it's a good question because historically, I mean, the apprenticeship levy has been around for quite some time now, but I've never known HMRC to have actually look at the apprenticeship levy or even seek apprenticeship levy on settlements where they've actually walked away with PAYE and NIC estate. It's only recently where HMRC have started doing that, but that's very sporadic in my experience. But in terms of doing an actual apprenticeship levy audit, It's not something I've come across at all, to be honest. But I think it's probably a matter of time before they do.
Another question's come in, so we've got two more. How difficult to sustain an argument that non-executive directors do not need to be on payroll?
Yeah, again, a very good question. So, I suppose the issue here is non-executive directors, in terms of the legislation, are regarded by HMRC as office holders. And because they're office holders, they naturally fall within the payroll remit, and therefore there should be POA and NIC operated. To answer your question directly, I think it's quite a difficult one. Even where you engage them through a personal service company, then that will still have implications on you in terms of POA and NIC. So short answer, very difficult in my view.
And the last question, can you please just re-clarify the position on employees reclaiming business mileage if they perform a regional role, work across a geographic region, they work from home and travel to various sites in the region?
Yeah, so I suppose the key question here to answer is, where is that person's normal place of work? Is it home, or is it one of those geographical areas? And quite often the only way to determine that is if well, to find out exactly how much time they spend at each of those sites. And I think what the question is asking me is, if you've got a home-based person that does all their admin at home, if they're not got any commitments or any meetings, they will carry out their home. Chances are they're probably home-based and they just go to different regions. In that scenario, I would suggest that each of those journeys are business, because they go in there for a temporary purpose or for a limited duration, and therefore they're probably more home-based rather than any of those particular geographical areas.
That's all the questions. Thank you, everyone.
Thanks, guys. Again, if you do have any further questions that you suddenly think of after kind of revisiting the slides that we do share at the end of this webinar, please do just email us at info@claritastax.co.uk. Like I said, I will share the slides and all the recordings, but please do check your junk emails in case it's fallen into there. And please do save this date. Again, I will be cascading the link to register, and this will be our last webinar for the series of webinars that we posted for 2024. And thank you very much again for your time.